Hello, I'm Ted Seides, and this is Investment Management Operations. This show explores the inner workings of the most sophisticated institutions in the industry. Through conversations with executives across operations, compliance, legal, and finance, you'll hear how key operating partners run their businesses in an ever-changing and complex investment landscape. You can join our mailing list and access Capital Allocators content at capitalallocators.com.
I'm Scott McDonald, and I'm your host. My guest on today's show is Eric Wortman. Eric is the COO of Stable, a GP stakes firm with over $4.5 billion in assets. If you are an emerging manager or thinking about spinning out, this is the episode for you. As people will tell you, building your own firm and team is vastly different than managing a portfolio. We covered the fuzzy topic of what it means to be institutional, how to select the right service providers, critical tech, talent acquisition, and other foundational areas of launching a firm. We then tackle best practices on designing a repeatable sales process, the importance of branding, and common areas that slow down early stage managers. Please enjoy my conversation with Eric Wortman. Eric, thanks for joining me today. I'm excited to talk about backing emerging managers, but first, I'd like to hear about your path to Stable.
Thanks for having me. Started my career in public accounting. So I'm a recovering CPA. Worked at a firm called Rothstein Cass. It's since been acquired by KPMG, but Rothstein Cass was almost entirely dedicated to the alt space. So all of my clients were hedge funds, private equity funds, VC. Really interesting blend of this 10,000 foot view and a 1-inch view of the alts industry at the same time. So you get a little bit about how these businesses operate and a whole heck of a lot of what story the numbers and financial disclosures might say. And so public accounting, for all the knocks, still provides just an incredible baseline knowledge to really any particular sector. It was my first role out of school. There's other generic lessons from there that I've carried with me throughout my career. Care and client service and interactions, and second, organization and time management. From RK, I moved over to AllianceBernstein. Started there in an operational due diligence role. So they were just first starting their alts group focused on external investment management exposures. It was a means of diversifying some of their internally managed strategies for different distribution channels, private client, retail, and institutional. And so I was tasked with underwriting the businesses, operations, infrastructure of well over 100 funds and general partners of all shapes and sizes, all strategies. As our little business within a much larger business grew, I ultimately ran point on our operations and infrastructure and reporting and product development. And so I really had this front row seat to the machine that is a large asset management firm, liaising and leveraging centralized infrastructure teams and resources throughout the organization. Accounting issues, working with the centralized fund administration team who oversaw the external administrator, supporting the marketing teams with our portfolio data, working with tech teams to implement CRM and portfolio management systems and software, launching new, sometimes innovative products for ourselves, for private client channels. So it was truly a lesson in how large investment management businesses operate at scale, while also somehow managing to continue to grow and seemingly be somewhat nimble, even within that large structure, and what governance looks like, working with lots of different stakeholders and consensus building, all themes that have stuck with me as I pivoted to working now with a much smaller organization and new general partners launching their firms. From there, I joined Stable in 2019. Stable helps founders of emerging investment firms who are starting their firms from scratch or are looking for acceleration capital to scale by providing two things. The first is investment capital. So we commit significant capital in their fund, anywhere from 75 to 200 plus million. And the second is that we provide operating partner platform support across operations and distribution to help them scale and institutionalize. We do this across alternative asset classes, public and private markets. All the firms that we invest in are very early in their life cycle. They're either day one new launches and helping them get off the ground, but we're also investing with smaller, younger firms that may have been around for a couple of years, where we help them institutionalize their business, implement best practices, give them the help that they need on the business side to reduce distractions, help them focus on investing and It's effectively a form of acceleration capital. In 2019, we were less than 10 people with our first vintage, a couple of SMAs. We had 3 live GP stakes after successfully exiting some stakes from a prior era. Fast forward to now, we manage about $4.5 billion, again, on behalf of some of the most sophisticated and respected asset owners in the world.
And how many people do you have today?
Now we're at 20.
What are your roles and responsibilities at Stable?
When I joined, it was similar to how many younger, smaller organizations look. It was a bit of a one-man band on the operational side. The role was basically COO, CFO, CCO, CRO, coffee guy, pantry filler, wire connector, AV equipment specialist they've become over time as well, which was very, very eye-opening coming from a place like AllianceBernstein, where something as simple as your Outlook breaks, you pick up the phone and you call the support line. It's a mentality and a culture that we have here. And even as we've grown, even as roles have evolved, it definitely spills over to how we operate and even the support and underwriting that we do of our founders and the new investments that we're making. The playbook here is very similar to the one that we use in our investment model. It's similar to experiences and concepts that we've seen elsewhere. It's been about tactical hiring, outsourcing, process, technology for continued scale. On the hiring side, we've become more specialized and deeper in roles. We have a CFO, there's a director of operations, there's controllers, there's bifurcation within the marketing team, there's business development, there's investor relations. And so my role now is player coach. Sleeves are always rolled up. So it's keeping things on track. It's strategic initiatives pushing, it's prioritization, it's firefighting. If I have to get into a complicated NAV process or a deal structure or working on product design or HR matters or compliance matters, regulatory issues, it's still all encompassing, but we've managed as we've grown to put individuals in positions where they have core competencies leading to success for themselves, becoming more specialized in the roles that we have across the organization.
You talked about institutional. What is Stable's definition of being institutional?
Institutional really means running a business in a best-in-class way for the different points in that firm's life cycle. But in all those scenarios, regardless of where you are, it's covering critical bases of controls and LP transparency. Being institutional means you're not giving prospective LPs a reason to say no to an investment for anything other than strategy or fit or track record related reasons.
When you're backing these day one founders, they're coming to the table. Do they typically have a CFO or is it outsourced? What's a common setup from that perspective?
It's applying the same themes to each organization, but it might look and feel a little bit different depending on where they are, how much they're managing, what their starting budget might look like. But day one GPs, they may not have more than one person internally managing their operations, but with the right structure and outsourced relationships, you can achieve the same necessary level of segregation of duties or controls that are critical for LP underwriting. It's not a one-size-fits-all approach. It's highly dependent on the strategy. It's highly dependent on the asset class. So there's some variability to it, but we're looking to make sure that the same themes are implemented in all scenarios.
And is the primary driver for partnering with these firms, are they just looking for distribution?
Not necessarily. They're looking for capital, obviously, to propel their business. Sometimes that, and more often than not, has a knock-on effect on distribution support. But they're looking for know-how. They're looking for help setting up. Being a founder of an investment management organization, you haven't necessarily seen the whole picture. It's important to leverage your network. That can be piecemeal. What we bring to the table is operating know-how kind of across the board, helping them with everything from talent acquisition to service provider selection to budgeting exercises. There's a distribution support model as well. I think it's a combination of things. It's not necessarily limited to distribution. There are scenarios where it's an acceleration opportunity and people are looking for the capital to get them into a different ecosystem to be evaluated by larger allocators and asset owners.
I want to turn to compliance. My view would be most organizations starting off that you have a CFO, COO, and they probably have the CCO designation. And maybe they're working with a compliance consultant. When do you peel that off and create that seat that's dedicated?
I don't think it's a specific point in time of size. I do think it's about the complexity of the business and where you are. If compliance is taking up 50% or 40% or more of your time as someone with multiple responsibilities internally, you're probably talking about needing another resource to help. It may not be very dedicated or specific CCO, but it's got to be someone who is spending a good amount of time on compliance and supporting the named CCO. And then maybe over time, that other resource becomes a CCO. So it sort of depends. The outsourced arrangement, I think, works for basic blocking and tackling for longer periods of time. It ultimately comes down to the complexity of the organization and how it's grown.
What about the technology glide path? So the backbone, when somebody shows up, you have an emerging manager. How do you help these organizations scale from a technological and even service provider perspective to get that right match as you grow?
That's an evaluation of their strategy. It's often looking at it from almost like a minimum viable product lens and saying, okay, if you're managing a long short equity strategy, just coming up with an example, what are the right systems out there that are both cost efficient, that ensure that you've got proper controls, that you have straight through processing of your data, that feeds to the administrators, that feed to the counterparties, that eliminate the need for you to manually intervene in various aspects of the life of a trade. That's always one element of it. And so we're making sure that those things are going in place. And it's not always an order management system or a portfolio management system. It's strategy dependent ultimately. In other cases, it's focusing on, hey, you really should have a CRM in place on day one. It doesn't have to be the most expensive CRM, but something, because you're going to have all these client interactions and there needs to be a process around it and you need to track the information that you're getting and you have to be making sure that you're following up. And at some point, very, very quickly, tracking something in Excel is not going to work. It's just going to be too clunky, too cumbersome, and you're not going to be able to do it. And so we're trying to be very thoughtful about what is absolutely necessary to get something off the ground, what can scale with you over time, and what won't impair your ability to perhaps add pieces over time. So if you have an OMS or a portfolio management system, knowing, hey, in 5 years from now, we're hoping to be managing 4 different products and bringing in SMAs, and you're going to realize that you actually want some sort of in-house accounting system that whatever you're putting in today plays nicely with the other pieces that you might need in the future. And that's ultimately the goal.
So you have a lot of different organizations, different strategies, public, privates. You just have an evolving landscape of best-in-class service providers. How do you stay on top of all the moving pieces to be as consultative as possible to these organizations?
We benefit in a way of being somewhat more well-known in the industry now. We've been out there now doing this for some time where lots and lots of service providers, whether it's tech firms, accounting firms, administrators, they understand what we do and who we're talking to and what we're looking at. And so they're more often than not actually coming our way and spending time with us to make sure that we understand what their latest offerings are. That's one way. So it's less proactive and more inbound. Beyond that, though, we're constantly canvassing the market, whether going to industry events, talking with peers, and just trying to stay apprised. And we're always taking notes, documenting, and just having full inventory of the landscape based on every conversation that we have, whether it's with a GP, a service provider, everything gets recorded and documented. And so we have an inventory of everything.
And then on the fund admin side, I'd be curious of your view on if I'm looking for a fund administrator and I'm emerging manager, are you going to go to the big guy or are you going to actually go for more of a niche-y fund administrator, just given the trade-off?
We're often recommending an array of potential administrators. If one has not been selected, sometimes we're getting involved in situations where there's already a process in place or a group in place. We won't say you must go work with ABC administrator, but we'll say, hey, for what you do, here are the 3 options or 3 best options in our minds. And here are the trade-offs across the 3. More well-known, bigger, you're smaller relative to perhaps the rest of their client base, but they have some economies of scale. It might be maybe a little bit less expensive, but they have a certain core competency in what you do, and you'll be in relative good hands, but you have to make sure what team you're getting and where it's being serviced from and what specific accounting system they might be using, because if it's a large administrator, they might have 3 different accounting engines. And so you have to make sure that you're being put into the right process there. There's sort of a middle tier where maybe it's a little bit more costly in some way, but they really specialize in what you do. And we've seen them. We've seen them with that specific asset class, with other managers. And so it's a bit of experience in most cases. We're providing new founders with options, our thoughts on the pros, cons of each one, and trying to guide them to a very thoughtful decision that they'll ultimately be happy with. We're not trying to be forceful. We're trying to be consultative and ultimately lead them to an appropriate decision.
And then what about the talent side? I mean, how do you guys think about providing talent to these organizations to get that right fit?
First and foremost, we tell founders that it needs to be someone that you can be in the trenches with and that you can get along with and that you can trust. Second to that is that the personalities, the approach to how they do things should somehow be complementary to the founder. Maybe if the founder is a little bit more reserved, you can have someone who maybe is a bit more vocal, a bit more assertive, take charge. You want to have some sort of balance of personalities, but ultimately one where there's a deep level of trust and one where a friendship can ultimately be cultivated. That's above anything else. From there, the conversations that we're always having is like, okay, well, here's a stack of CVs that I've received, and how should I think about these different individuals? Some will have more accounting heavy experience. Some will have less of that and maybe more either operational, maybe more president-like type roles. And ultimately, it's about what the firm or what the founder is looking for and having someone who knows enough about everything, because that is really what the job entails. It's not micro level. Generally speaking, those individuals will have a stronger competency in one or more areas. Where they don't have it, it's about complementing that skill set with something else, generally outsourced. Again, because of some budget constraints, day one firms, you're not just going to be adding people for every little need that you have. If you have someone who has that sort of broad set of experience, but maybe lacks deep accounting experience, you can partner or couple them with an outsourced CFO shop, and they can provide both complementary support, even if they have deep accounting experience, supplementary support. It's a one-man band doing everything, which is not feasible. It's not good for anyone involved. It's not good for LPs. It's not good for the founder because they are going to be spread too thin. And so you need that support. And the way to do that is by coupling them with some sort of outsourced model that they can oversee that almost act as an extension of that person or the team.
And is there a tipping point? What's the moment when you're like, we should really bring this resource in-house? We're going to need to scale.
There is that moment where you need to add resources in-house, but you can continue to leverage that outsourced group. There may be a time, you could be talking, 5, 10, 15, 20, 30 billion, where at some point, actually, you've outgrown the original outsourced group that you're working with for what you had originally intended. But it doesn't, in my mind, happen earlier than either several products or double-digit billions of dollars in AUM. And even then, by the way, you could be managing $15 billion in one strategy, and the scale is still there. You're still leveraging the same process. You do want to make sure, though, that they are being overseen properly, because no matter what, you do have to have a quarterback internally. So when you're first launching, yes, you have that one-person band overseeing everything. As you grow, inevitably, even if you're only adding maybe one separate account or one other fund or one other product, you may need another person to really oversee that relationship, checking it, making sure that things are being done correctly, entries, books, trade processing, settlements, because as the COO, CFO, whatever other titles you might have, naturally as the firm grows, and we've experienced this, your time is being spent on other things that's evolving during that growth period.
Is there one thing that emerging managers tend to overlook or underestimate when they've come out of markets?
How much time and effort is required to launch the organization? That tends to be the biggest thing. It's an eye-opening experience. It's a lot of blocking and tackling to get there. In some cases, you're just running into a wall every day and picking yourself back up and repeating it the next day just to get a fund off the ground. There are so many moving pieces across hiring fund counsel and getting fund formation going and counterparty agreements and trading systems. I think it tends to be the biggest eye-opening experience. Once that sets in, there tends to be this, let me leverage relationships, let me leverage a strategic partner. Oh my God, I got to get a COO in place immediately. You need to be able to delegate these things. I think the founders quickly realize what's at stake and what needs to happen.
And what about fund formation and the legal costs? In most situations, costs go down over time. Does that apply here?
Generally speaking, costs of partners at law firms and the support model there has gotten more expensive over the last 4 to 5 years. But at the same time, the approach that we take and what we guide our founders and our COOs as they are engaging counsel is there are ways to work with your respected law firms and the ones that you really want to work with in a way that can result in a bit more economic efficiency for your clients ultimately, because you're talking about accruing lots of org costs to get that launched. And ultimately that's going to impact performance and high watermarks and the like. And so those are things that you have to be sensitive to. And so there are ways to approach that and ensure that you're spending an appropriate amount where everyone involved is sort of happy. So what is that? One, it's having a candid conversation up front. It's one of the first conversations that we have. Who are you working with? Do you have one? We're making recommendations. And what will this body of work cost? Here's the strategy. We've helped you with the terms already. We've done a peer analysis. We've benchmarked how you're thinking about it. There won't be a ton of open questions because open questions ultimately drive the costs of legal work. It's a lot of back and forth and it's changing, it's pivoting. You want the expert, higher priced law firms or lawyers that you're engaging, focusing on the most valuable thing that you can get from them, which is whether it's their expertise on fund formation or some sort of regulatory or investment angle to it, but having them focus on the things that really matter. And then for the things that maybe are more commoditized, don't have them focus on it. There are firms out there that specialize in counterparty and onboarding and service provider agreements and trading agreements, and they're quite well known within the industry. Going with someone like them rather than partners at a law firm that are $2,000 an hour to negotiate service provider agreements where the range of outcomes are very, very narrow. It makes a lot more sense to go with a group that specializes in that might be lower cost and ultimately resulting in pretty significant savings in the overall project. And so there's a way to engage with legal resources today that ultimately result in savings than perhaps there was 10 years ago because you didn't have some of these specialists out there or these other groups out there. Even things like reviewing and negotiating NDAs with whether it's prospective LPs or you're talking with prospective investments, it cuts both ways. And there are groups out there, there's technology out there that can do that for you in a much more cost-effective way.
Let's talk about marketing. Do emerging managers market well?
They can. They wouldn't be embarking on this process necessarily if they weren't able to market or they didn't have conviction in their ability to market themselves and tell a good story. So I think inherently the skill set tends to be there. Not always, but it tends to be there in some form. Sometimes you need a complementary person to help convey that story, but the story is ultimately coming from the founder. Where we see them falling shorter is on the process overall. We're often guiding founders to bring in someone in a marketing and an investor relations capacity as early as possible. And that doesn't necessarily mean you need to hire the most expensive marketer out there with a massive Rolodex, but you do need to control the process. You do need to be very tactically approaching certain groups. You have to be managing the cadence of follow-ups. You have to be tracking information in a CRM. You need someone to own that process end to end. And that's where we've seen in our experience younger firms, emerging firms fall short when it comes to the marketing effort.
What's a good process from your perspective if you had to just create a linear form?
It starts with branding. It starts with pitch decks and the story and the narrative and doing mock pitches with friendlies. You're not putting yourself out there yet until you refine your pitch. Having a CRM in place, having a person in place to ultimately run that process and own it. And then this is where we come in, is being thoughtful about when or how you're approaching certain allocators or asset owners, because you really only get one bite at the apple. And if you approach it when either you're not ready or you haven't refined your pitch or you haven't diligenced the group that you're approaching and what they're looking for or how they categorize your strategy or how they think about your strategy or who the right people are, it could be one and done. The more one and dones you have, the less likely you are going to be successful at raising money. It's almost like this scorched earth concept. You've kind of run the gamut and you're not going back to them. It's very, very challenging once a group either says no or implies no and you sort of move on. It's very important to be well organized and practiced before you go out there and start that exercise. We have playbooks for this. This is what we're bringing to the table to ultimately help them succeed.
And what about branding, PR? I think a lot of organizations say, yeah, we don't have the money for that. Do you prioritize that?
We prioritize branding up front. We do think it's important. It doesn't have to be a super expensive branding exercise. I mean, you're talking about pitch deck design and logos and some sort of theme to it all. You don't have to pay a brand consultant for principles and mission statements and the like. It doesn't necessarily have to be a super expensive, significant engagement, but there's a lot to be said for branding optically and pitch deck design and getting that right and getting it well organized and succinct in terms of messaging for your first foray out there. So we do prioritize that absolutely. PR, less so early on, but it is something that we talk about with founders because it is very important. It's important to at least establish relationships with the right PR folks and organizations that if something happens or you are going to do some sort of campaign or something, they are incredible at what they do. It's important to have that connectivity. It's not necessarily something that we're pushing upfront at launch.
Is there anything that you learn from your interaction with your LPs that actually cascades down to kind of how you've approached implementation at the manager level?
First principle is knowing your LPs. It's a critical lesson that founders may underestimate a bit. And I'm not just talking about basic KYC. It's really understanding what makes them tick, their sensitivities, their reporting needs, how they report maybe to their boards and their governance structure, what information they might need. The more you know early, the more you can structure around that. It is a partnership through and through.
I want to turn to things that slow people down. So potholes, any case studies that you see out there that are worth sharing?
There's certainly lots of generic concepts to be mindful of when you're launching an organization and thinking you have to do something in a waterfall approach when it definitely needs to be more of an agile approach given the volume of things that need to get done. And there's FCA approval. A lot of people launching in the UK may not realize that it can take 6, 8, 10, even 12 months to get regulatory approval. Not for any negative reasons. It's just how that process works. Rather than let time and market opportunity pass you by, there are other solutions, regulatory hosts and the like that you can leverage to more quickly get your organization off the ground and approved to be able to trade and not let market opportunities pass you by. At the same time, if you're doing that, when you're setting up your fund docs, when you're part of a regulatory host, you have to list that regulatory host as the named investment manager, and then there's an investment advisor that sits underneath it where responsibility gets delegated to. And you have to, in your fund docs, almost pre-clear this, hey, at some point in the future, we're going to have our own regulatory approval and we need to flip the switch. If you don't put that in your fund docs up front, and let's say you've got 1, 5, 10, 15, 20 investors that are in the fund, you have to go to them for this consent process, this approval process, almost pre-baking your fund docs in a way that facilitates an orderly move from something that was maybe intended to be temporary to something more permanent once it comes through correct for. Generally thinking about future-proofing fund structures to facilitate business development, that's another big one. Some concepts around asset liability matching. So if you're a distressed credit strategy, for example, it's probably not the best idea to offer 100% liquidity on any quarter or month end. That's a recipe for probable disaster at some point. Being very mindful of that, even if we're not involved, but at least sanity checking it with peers, sanity checking it with counsel, not pushing, not overriding, but hearing the feedback and being very receptive to the feedback and what the market is screaming at you. There's so many people out there that have lived it and have experienced it, and it's really about being in tune with that and being aware of it. And so there's other things from a business development perspective. If you think co-investments are going to be a part of your strategy, assuming there's no leverage involved and there are things that exist in your main fund, you could facilitate fresh capital coming in through co-invest share classes in an existing fund rather than having to scramble and launch an SPV, or at the time, launch a new share class. Like there are a lot of things that you can do upfront that will make your life a lot easier and help you facilitate opportunities for fundraising and expansion.
There's always a little bit of chatter about organizations coming together with atypical fee structures. Is that something you see in the market when you're looking at managers saying, look, this is a little too creative and we're going to spend more time talking about how the fee works versus just coming up with something normal?
Absolutely. You don't want that to be a point of focus for really any prospective LP. If LP is having to spend time focusing on it, is probably not a good idea. You don't want to give prospective LPs a reason to pass for anything that's not strategy or performance related. If there's too much brain damage on whether it's a term or a process or a structure of a fund or asset liability mismatch, it doesn't breed a successful outcome.
Let's turn to the future. Where are we going in the industry? Is there anything that you guys are focused on at Stable when you think about growing, building partnerships and with more information and data that's out in the market?
There's our own process, how we're taking inbound information. We're talking about hundreds, if not thousands of inbounds a year. So how do we process that in and leveraging technology to do that? Even in our underwriting process, we do a lot of work. It's very, very hands-on. Our underwriting is really the same as our operating partner platform. It sort of all gets rolled out at the same time. But at the end of the day, it all needs to get documented. Are we spending dozens of hours typing something up? Or do we have data room information, lots of structured notes, lots of quantitative data that we've collected? And how do we process that into full form diligence memos? We're looking at it from both ends. The development of technology out there is significant. And so that's a little bit of a preview into our own process and how we think about things.
Two closing questions. One is, what advice would you give to an emerging manager from an operational perspective? Which we covered most of this. So I don't know if there's anything left to talk about.
It's really leveraging your network. Even if you're not talking to a strategic partner like Stable, it's leveraging your network. If you've been in the industry, that means that you know people at service providers and counterparties and other organizations and other people who have done this before. The launch process and what's involved is not novel. Don't try to figure everything out on your own. Don't operate in this vacuum. Leverage the people around you, leverage the network around you, and you'll more often than not get pretty sound guidance and frameworks for how to go about launching your organization. I think that's most critical. There's lots of other tactical things, but that's the most important.
And then the other thing is one book, resource, or other material in the industry that you commonly refer to people.
It's probably our own playbooks. It's information that we produce. I mean, if someone is looking for a quick know-how, we've got overviews and guidelines on our website. And obviously there's more information and more frameworks behind it as we stay on top of industry trends or service provider developments or process or best-in-class processes. A lot of that gets updated. And so it's a scalable way of sharing our own knowledge with the industry and people that we're engaging with.
Awesome. Eric, thanks so much for the time and your insight. I learned a few things and look forward to staying in touch.
Thank you, Scott. This is great.
Thanks for listening to the show. If you like what you heard, hop on our website at capitalallocators.com, where you can access past shows, join our mailing list, and sign up for premium content. Have a good one, and see you next time.